You see, the market has a peculiar habit. It whispers long before it shouts. Most people wait for the shout. They wait for the explosion, the dramatic move, the candle that runs wild across the chart. But by then, the opportunity is already halfway spent. The professional, well, he listens for the whisper. Now let me ask you something. Have you ever noticed how price behaves just before a big move? I mean, really noticed it. Not guessed, not hoped. Observed it with patience, like a man watching the tide roll in before a storm. Price rarely explodes out of nowhere. That's the first truth a trader must accept. Before a breakout, the market almost always shows its hand. Just a little. The signs are there for the man who has trained his eyes and his mind. You see, the crowd believes that the breakout is the signal. They wait for the candle to shoot up or plunge down, and then they rush in, full of excitement. But excitement is not a trading strategy. It never was. The real operator studies the quiet moments. Think about it for a moment. What happens before pressure bursts through a pipe? The pressure builds first, slowly, silently. The market works the same way. Price begins to tighten. Volatility contracts. The range narrows. The candles become smaller. To the untrained eye, the chart looks boring. Nothing happening. But the experienced trader knows something important is taking place beneath the surface. Accumulation, or distribution. The large operators, the men moving real money, they cannot buy or sell everything at once. Their orders are too large. They must work their positions carefully, quietly, over time. So what do? They build positions inside consolidation. And that is where the patient trader finds his opportunity. Let me ask you another question. When you look at a chart and see price moving sideways for days, sometimes weeks, do you grow impatient? Do you start hunting for trades elsewhere? Most traders do, but the man who understands speculation knows that the sideways market is not wasted time. It is preparation. Preparation for a move. Price is like a coiled spring. The tighter it coils, the stronger the release. Now I want you to imagine a chart where price has been moving inside a narrow range. The highs keep getting tested. The lows keep getting defended. Volume begins to change character. Something interesting begins to happen. The pullbacks become weaker. Have you seen that before? Price tries to drop, but the sellers cannot push it very far. Buyers step in sooner each time. The dips become shallow. The recovery becomes quicker. What does that tell you? It tells you demand is quietly gaining control, and yet the breakout hasn't happened. This is where discipline enters the picture, because the temptation, the great temptation, is to jump in too early or too late. The inexperienced trader buys the first green candle he sees. The fearful trader waits until the move is obvious to everyone on the planet. But the skilled operator watches the structure. Higher lows forming beneath resistance. Compression building. Volume tightening. And he asks himself a simple question: who is winning this fight? Because every chart is nothing more than a battle between supply and demand, and when one side begins to weaken, the chart begins to reveal it. But let me tell you something else. Chart patterns alone will not make you a successful trader. Many people learn patterns. Very few learn patience. Patience is capital. You must learn to sit still while the market prepares its move. You must learn to observe without feeling the need to act. Now ask yourself honestly, how often do you take trades simply because you feel you should be doing something? That urge is expensive. The market pays the patient man and taxes the impatient one. When a breakout is truly approaching, the chart begins to breathe differently. The volatility contracts, but the pressure builds. Imagine a lid on a boiling pot. The water underneath is heating up. The lid rattles slightly, but it hasn't blown off yet. That's what a proper setup looks like. And the trader who understands this doesn't chase the explosion. He anticipates it, not by predicting the future with certainty. No man can do that, but by recognizing the conditions that make an explosion more likely. You see, speculation is not about certainty. It never was. It is about probability. You place yourself in situations where the odds lean slightly in your favor. Then you manage your risk, so that one mistake does not remove you from the game. That is the professional approach. Let me ask you something important. When price approaches a major level again and again, what is it really doing? Most people believe resistance grows stronger each time it is touched, but the market often behaves the opposite way. Each test removes orders from that level. Each push absorbs supply. And eventually there comes a moment when there is simply not enough supply left to stop the move. That is when price breaks. And when it breaks, it moves quickly, because the barrier that held it back has disappeared. But remember this, the move begins before the breakout candle. It begins during the quiet tightening of the range. It begins when sellers can no longer push price down. It begins when buyers become more aggressive without allowing the price to fall. The chart tells a story long before the headlines appear. But here's something many traders never realize. Your mindset determines whether you can see the story. A trader who is desperate for profit sees random signals everywhere. A trader who is calm sees structure. That difference matters more than any indicator. You see, the greatest edge in speculation is not a secret pattern. It is the ability to think independently from the crowd. The crowd reacts. The operator prepares. And preparation begins with observation. You study how price moves inside consolidation. You watch how volume behaves near resistance. You measure how quickly the market rejects lower prices. Little clues, small details, but together they paint a picture. Now I want you to imagine you're watching a chart where prices spent days pressing against resistance. Each dip is shallow. Each recovery is quick. The candles are getting tighter. The range is narrowing. Momentum is quietly building. And you ask yourself, is the market preparing for a breakout? Or is it preparing to trap the impatient trader? That question alone can save you a great deal of money. Because not every compression leads to expansion. And the man who survives in this business is not the one who guesses correctly every time. It is the one who protects his capital when he is wrong. Capital is the trader's inventory. Without it, the game ends. So when you prepare for a breakout, you are not making a reckless bet. You are positioning yourself carefully. You define your risk. You identify the level that proves your idea wrong. And only then do you participate. This is the difference between gambling and speculation. One relies on hope, the other relies on preparation. And as you continue watching the chart, you begin to notice something subtle happening beneath the surface. Most traders believe that the more times a resistance or support level is tested, the stronger that level becomes. It sounds logical, doesn't it? If price hits the same ceiling again and again and fails to break through, the natural assumption is that the barrier must be powerful. But the market often behaves in a way that punishes simple assumptions. You see, a level in the market is not a wall made of stone. It is simply a cluster of orders, nothing more. When price approaches resistance, what actually stops it from rising further are sell orders sitting at that level. Institutions, large traders, and even smaller participants place their sell orders there because they believe price will not go higher. But here is the part many traders overlook. Each time price touches that level, some of those sell orders are being consumed. Think about it carefully. When buyers push price upward into resistance, they are buying everything that is available at that level. The first test absorbs some of the supply. The second test absorbs more. The third test removes even more of those sellers from the market. Now let me ask you something. If the supply sitting at resistance keeps getting eaten away, what do you think eventually happens? There comes a moment when there simply are not enough sellers left to hold the price down. And that is when the breakout occurs. The chart often reveals this process quietly. Price approaches resistance, pulls back, then comes back again. Each pullback becomes smaller. Each return happens a little faster. The market is telling you something if you're willing to listen. Demand is persistent. Buyers are not giving up. Instead of collapsing after rejection, price stabilizes and begins pressing upward again. That pressing action is important. Very important. You might notice the candles beginning to cluster near the level. Instead of sharp rejections downward, the market starts hovering just beneath resistance. Almost like it is leaning against the door. Have you ever tried pushing open a heavy door? You lean your weight into it again and again until the latch finally gives way. Price behaves in a similar manner. The repeated tests are not strengthening the barrier, they are weakening it. Now consider the opposite situation. Price approaches support repeatedly from above. Each bounce becomes weaker. Sellers keep pushing the market downward. Buyers manage to hold the level for a while, but their strength is fading. Eventually the buyers run out of ammunition. And when that happens, support collapses. This is why experienced traders pay close attention to the behavior between tests. It is not the level itself that matters most. It is the reaction. Does price snap away violently after touching the level? That suggests strong opposing pressure. Or does price linger near the level, refusing to move far away? That suggests pressure building on the other side. Many traders make the mistake of selling every touch of resistance or buying every touch of support. They believe the level is an automatic signal. But markets are not that simple. Levels are areas of negotiation between buyers and sellers. Sometimes the defense holds. Sometimes the defense weakens. And if you watch closely, the chart often shows signs of exhaustion from one side of the battle. Look at the pullbacks. Are they deep or shallow? Look at the time spent near the level. Does price retreat quickly, or does it stay nearby? Look at the momentum. Is the market approaching the level with strength or drifting toward it without conviction? These details matter more than the level itself. You see, the market is constantly shifting balance between supply and demand. When price keeps returning to a level despite repeated rejections, it often means one side of the market is slowly gaining control. The inexperienced trader sees multiple rejections and assumes the level will never break. The experienced trader begins asking a different question. If the market keeps knocking on the same door, how long before it opens? Because the truth of speculation is this: barriers in the market rarely last forever. They hold only as long as the opposing side has enough orders to defend them. Once those orders are gone, price moves swiftly into the empty space beyond the level. And that moment often surprises the crowd, not because the breakout was unpredictable, but because most traders were looking at the level itself instead of studying the pressure building around it. And when price begins pressing against resistance again and again, with pullbacks becoming weaker and the range tightening just beneath the ceiling, the careful observer starts to notice something changing in the character of the market. A market often reveals its intentions in the way it pulls back. Most traders spend their time staring at the big candles, the sudden spikes, the dramatic moves. But the professional observer studies something quieter: the quality of the pullbacks. Now let me ask you something. When price approaches resistance and then drops sharply every time it touches it, what does that tell you? It tells you sellers are aggressive. They are eager to push the market down, and buyers are not strong enough to hold the ground. But when the opposite begins to happen, the story starts to change. Imagine price moving upward toward resistance. It touches the level and pulls back, which is perfectly normal. But the next dip is not as deep as the previous one. Buyers step in sooner. The market stabilizes faster. Then price pushes up again. Another pullback follows, but this time the drop is even smaller. The decline lacks urgency. The candles drift downward slowly rather than collapsing. Have you noticed that behavior before? That is what traders call a shallow pullback, and shallow pullbacks often reveal something important happening beneath the surface. They suggest that buyers are quietly absorbing supply. You see, strong demand does not always show itself through explosive green candles. Sometimes it shows itself through refusal, the refusal to allow price to fall very far. Each dip gets bought. Each decline attracts demand. Instead of sellers dominating the pullback, buyers begin stepping in earlier and earlier. That subtle shift matters. The market is telling you that participants are becoming more confident at higher prices. They are no longer waiting for deep discounts. They are willing to buy sooner. Now think about what that does to the structure of the chart. The lows begin creeping upward. The range tightens. Price spends more time near the upper boundary of the range rather than falling back toward the bottom. This creates pressure on resistance. You might look at the chart and see what appears to be a simple sideways market. But inside that range, a quiet battle is unfolding. Sellers attempt to push price down. Buyers refuse to let it fall. And with every shallow pullback, buyers gain a little more ground. But here is something many traders misunderstand. Shallow pullbacks are not signals by themselves. They are clues. They must be interpreted within the context of the broader structure. If the market is trending upward and pullbacks remain small, it often means the trend is healthy. Demand is strong enough that sellers cannot push price very far before buyers step in again. But if pullbacks suddenly grow deeper, something has changed. Sellers have regained some control, so the trader's task is not to react emotionally to every movement. His task is to observe the behavior of the market over time. Let me ask you another question. When price pulls back and quickly recovers, what does that say about the traders who wanted to buy lower? It means they never got the chance. The market did not give them the discount they were waiting for. And because of that, many of them begin chasing the price upward. That creates additional demand, and demand that chases price tends to accelerate movement. This is why shallow pullbacks often appear just before strong breakouts. The market is building pressure because buyers are consistently stepping in earlier. Sellers try to push the market down, but the effort becomes less effective each time. You might notice candles with long lower wicks forming near support within the range. Those wicks are evidence of buyers rejecting lower prices. The market dips, buyers step in, and price returns upward, over and over again, and with each repetition the message becomes clearer. Demand is persistent. Supply is slowly being absorbed. Eventually the market reaches a point where sellers simply cannot create meaningful pullbacks anymore. The downward attempts become weak and short-lived. At that stage, price often begins clustering near resistance. The dips become so small that the market almost appears to be resting just beneath the level. To the impatient trader, it may look like nothing is happening. But the careful observer understands that something important is unfolding. Buyers are holding their ground. They are not allowing the market to fall away from the level. They are comfortable buying at higher prices, and that confidence begins to show itself in the structure of the chart. And as this process continues, the space for price to move becomes narrower and narrower until the market is pressing tightly against resistance, with each shallow dip being quickly absorbed by demand. When a market stops trending and begins moving sideways, most traders lose interest. They look at the chart and say nothing is happening. No excitement, no big candles, no obvious direction. To them, a sideways market feels like wasted time, but the experienced operator knows better. Because what appears quiet on the surface is often where the most important work is being done. You see, large money cannot move the way small money does. A retail trader can enter or exit a position instantly with a single click. But institutions, funds, and large operators deal with positions that are far too large to execute all at once. If they tried to buy everything in one moment, price would surge violently against them. If they tried to sell everything instantly, the market would collapse before they finished their orders. So they do something different. They accumulate, or they distribute. And this process often takes place during consolidation. Let me ask you something. Have you ever wondered why price sometimes spends days or even weeks moving inside a tight range? Why it keeps bouncing between the same boundaries without committing to a clear direction? It is rarely random. Inside that range, large participants are quietly building positions. Accumulation occurs when strong hands are gradually buying shares, contracts, or assets over time. They do it patiently, absorbing the available supply without attracting too much attention. Price may dip slightly within the range, and they buy more. Price may rise toward the upper boundary, and they pause. The goal is not speed. The goal is position building. You might see the market bouncing back and forth between support and resistance, appearing almost boring. But beneath that quiet movement, ownership of the asset is slowly changing hands. Weak hands sell. Strong hands buy. The chart might show repeated dips toward support where price suddenly stabilizes and reverses. Those areas often represent demand entering the market. Buyers absorb the selling pressure and prevent the price from falling further. Now consider the opposite scenario. Distribution. In this phase, large participants are gradually selling their positions after a sustained rise. They cannot unload everything instantly without pushing price downward too quickly. so they sell in pieces. Price rises toward the upper part of the range, and supply quietly enters the market. Buyers push the market upward, but they encounter selling pressure. The market drifts lower again. Then buyers attempt another push upward, but the selling continues. This process repeats again and again until the strong hands have distributed most of their positions. To the average trader, both accumulation and distribution look similar. Just sideways movement. No clear trend. But the behavior inside the range often reveals the truth. Look at the reactions near the boundaries. Does price repeatedly bounce off support with strong recoveries? That may suggest accumulation. Or does price struggle near resistance, with rallies becoming weaker each time? That may suggest distribution. Time spent inside consolidation also matters. The longer the market remains within a range, the more significant the eventual breakout tends to become. Why? Because energy is building. Positions are being formed. Supply and demand are gradually shifting balance. Think of it like pressure building beneath the surface of the market. The longer the preparation, the stronger the potential movement once price escapes the range. But the challenge for traders is patience. Many participants grow frustrated during consolidation. They try to force trades inside the range, chasing small movements that offer little reward compared to the risk. The experienced trader watches instead. He studies how price behaves within the range. He observes where buyers appear. He notices where sellers defend. He waits for the clues that reveal which side is gaining control, because eventually the range ends. The market cannot remain balanced forever. When accumulation completes, demand overpowers supply and price breaks upward. When distribution finishes, supply overwhelms demand and price breaks downward. But the breakout itself is only the final chapter of the process. The real story has already been unfolding inside the consolidation. The quiet buying, the gradual selling, the repeated tests of support and resistance. And for the trader who trains his eyes to recognize these subtle signs, the sideways market stops looking boring and starts looking like preparation for something much larger beginning to take shape within that tight, seemingly uneventful range. One of the quiet habits of the market is that it rarely moves from chaos directly into greater chaos. More often, it moves from calm into storm. And that calm, if you learn to recognize it, can tell you a great deal about what may come next. Traders call this volatility contraction. Now let me ask you something. Have you ever looked at a chart and noticed how the candles slowly begin to shrink? The ranges get smaller. The swings from high to low become tighter. What once moved 50 points now moves 20. What once moved 20 now moves 10. The market begins to breathe more slowly. To the impatient trader, it feels like nothing is happening. They become restless. They start searching for action somewhere else. But the patient observer recognizes that quiet markets are often preparing for movement, because volatility behaves like a cycle. Periods of expansion are usually followed by contraction, and periods of contraction are often followed by expansion. Think of it like stretching a rubber band. The more it tightens, the more energy is stored inside it. Eventually, that stored tension releases. Price behaves in a similar way. When the range becomes narrow and movement slows down, pressure is building beneath the surface. Orders are being placed. Positions are forming. Buyers and sellers are negotiating ownership of the asset, and while the chart may look quiet, the market is preparing. Let me ask you another question. What happens when traders grow bored? They leave. Volume dries up. Activity fades. Price begins drifting inside a smaller and smaller range. The market almost appears asleep. But markets do not sleep forever. Eventually something shifts. A wave of buying appears, or a wave of selling arrives. And because volatility has been compressed for so long, the release often comes quickly. The candles expand. The range widens. Momentum enters the market. This is volatility expansion. Now here is something worth understanding. The expansion itself is not the beginning of the move. It is the release of pressure that was building during the contraction. The real preparation happened earlier, during the quiet tightening of the range. But many traders only notice the move after it has already begun. They see the large candle and suddenly feel excitement. They rush into the trade because the market finally looks alive again. Yet by that point, A portion of the move may already be behind them. The skilled operator pays attention to the contraction phase. He watches how price behaves as volatility decreases. Are the highs and lows becoming tighter? Is the range narrowing near an important level? Is the market compressing beneath resistance or above support? These small details matter, because volatility contraction near key levels often signals that pressure is building for a potential breakout. Imagine price slowly squeezing into a tighter and tighter space beneath resistance. Each rally stops near the same level. Each pullback becomes smaller. The chart begins to resemble a coiling spring. Buyers and sellers are both present, but neither side is making a decisive move yet. The tension grows. And when that tension finally releases, the move can be swift. But there is something else a trader must remember. Not every contraction leads to expansion in the direction you expect. Sometimes the market compresses, draws in traders anticipating a breakout, and then moves sharply in the opposite direction. This is why preparation must always include risk management. You observe the contraction, you recognize the conditions for expansion, but you never assume certainty. Speculation is a game of probabilities, not guarantees. Still, the pattern repeats itself across markets and across time. Wide ranges eventually narrow ranges eventually expand. And the trader who trains his eyes to recognize these shifts in volatility gains a valuable advantage. Because when most traders are complaining that the market is slow and boring, the observant trader begins to understand that the quiet tightening of price movement may be the market's way of gathering strength before it finally decides to move with purpose. Patience is one of the most misunderstood truths in trading. Many people believe trading success comes from constant activity, entering positions, catching every move, staying involved with the market every hour of the day. It sounds productive, doesn't it? The more you trade, the more chances you have to win. But the market has a way of punishing that thinking. The professional trader understands something that most beginners learn the hard way: activity and progress are not the same thing. Let me ask you something. When you open your chart and see price drifting sideways, candles small and direction unclear, what do you feel? Do you feel calm, or do you feel restless? Many traders feel an urge to do something. Anything. That urge is dangerous, because the market does not reward constant action. It rewards correct action. And correct action often requires waiting. You see, good opportunities in trading are not evenly distributed throughout the day or week. They appear in clusters. Sometimes the market offers clear setups, strong momentum, and obvious structure. Other times it offers confusion, noise, and traps. The patient trader understands this difference. He does not feel pressured to trade when conditions are unclear. Instead, he observes. Think about a hunter in the wilderness. He does not run blindly through the forest hoping to stumble upon his target. He studies the terrain. He watches the patterns. He waits for the right moment. Trading requires the same discipline. Now ask yourself another question. How many trades have you taken simply because the market was open and you felt you should be involved? Many traders confuse participation with opportunity. But the truth is simple. The market will always be there tomorrow. Your capital might not. That is why patience becomes a form of protection. When price is moving randomly, entering a trade is often little more than a coin toss. There is no clear advantage, no clear structure, no logical edge. Yet many traders still take those trades because they feel uncomfortable sitting still. The experienced trader does the opposite. He becomes comfortable with inactivity. He watches the chart as it forms patterns, tests levels, builds pressure, and reveals its intentions slowly over time. Patience allows him to see what impatient traders miss. Consider a market that is compressing beneath resistance. The candles grow smaller. The range tightens. Pullbacks become shallow. The structure begins to suggest that demand is quietly building. This process might take hours or even days. An impatient trader may enter too early, guessing at the breakout. If price pulls back slightly, fear enters the picture and the position is closed prematurely. But the patient trader waits. He allows the market to reveal confirmation. He observes how price behaves around the key level. He studies the reactions, the strength of the pullbacks, the persistence of buyers. Waiting does not mean doing nothing. It means observing with intention. It means letting the market show its hand before committing capital. Now think about the emotional difference between these two approaches. The impatient trader experiences constant stress. Every candle becomes a source of anxiety. Every small movement feels significant. The patient trader sees the market more clearly because he is not emotionally tied to every tick. He knows that most of the market's movement is noise. Only certain moments matter.